Welcome to the Explainer. Today, we're taking a pretty fascinating journey from that device sitting right there in your pocket, deep into the hidden, incredibly high-stakes world of global finance. You probably interact with your bank every single day, right? Checking balances, grabbing a coffee, splitting a bill with friends. But the layers of security protecting your money during those mundane, everyday actions are completely invisible to us. So we're going to pull back the curtain on exactly how that shield works, from the glass on your screen all the way to the global networks actively hunting down illicit funds. Okay, let's dive into this. Think about your own daily banking habits for a second. When you just need to quickly check a balance or transfer some cash, what do you reach for? Your smartphone or your laptop? It's a micro decision we all make casually, honestly, almost without thinking about it. But the security implications of that choice are actually massive. Let's break down exactly why. When we look at what the experts say, the vulnerabilities of these two devices are remarkably distinct. On one hand, smartphones actually have a slight edge when it comes to software security. Why? Well, purely because you have to manually agree to downloads from highly regulated approved app stores. It's significantly harder to accidentally install some hidden keylogger that's quietly tracking your passwords. But because your phone goes everywhere with you, it's highly susceptible to physical theft or simply shoulder surfing. Someone secretly watching you tap your PIN while you're just standing in line at the grocery store. Computers, conversely, are fantastic when they're sitting safely on your secure home network. They give you a nice, large screen to easily spot weird irregularities in your account. However, they are incredibly vulnerable to hidden malware downloads from the broader internet. And if you ever make the critical mistake of doing your banking on an unsecured public Wi-Fi network at a local coffee shop, yeah, you're wide open. Oh, and remember, all of those built-in software protections on your mobile device, they instantly disappear if you're using a jailbroken or rooted phone. So what's the actionable takeaway here to really lock down your personal security? Experts universally agree on this. Skip the mobile browser entirely. Navigating to your bank through a web browser leaves you super exposed to cleverly disguised phishing sites designed to steal your credentials. By simply using the official bank app, you bypass that risk completely. And crucially, you've got to team up with your bank by enabling two-factor authentication. Two-factor acts as an absolute barrier. It ensures that even if someone manages to guess or steal your password, they are stopped dead in their tracks before they can touch a single cent. All right, now that we understand the basic device risks, let's move into Section 1, 2025 Mobile Banking Trends, Upgrading Your Personal Vault. Let's move to and see how this builds on our everyday user experience. In 2025, consumer banking is deploying some incredibly advanced tech. We're talking AI-powered personal finance assistants, analyzing your spending in real time to spot anomalies instantly. We're seeing enhanced biometrics, and this is wild. It's no longer just scanning your fingerprint or your face. We're talking voice recognition and continuous behavioral biometrics. The system actually analyzes how fast you type, the specific angle you hold your phone, and the pressure of your taps to verify it's really you. Add in instant real-time payments, the immutable security of blockchain, and seamless digital currency integration, your mobile app is rapidly becoming an absolute fortress. Which brings us to Section 2, the zoom out, the hidden war against financial crime. Because here's where we need to introduce the iceberg metaphor. The screen locks, the complex biometrics, the two-factor authentication on your phone, that is literally just the tip of the iceberg visible above the water. Now we're plunging deep underwater to look at the massive institutional defense net. To truly understand why banks even need this massive underwater infrastructure, you have to grasp the sheer, terrifying scale of the threat. The Financial Action Task Force estimates that criminals launder between $800 billion and $2 trillion globally every single year. Let that sink in for a second. That is 2 to 5% of the entire global GDP. It's not some localized issue. It is a staggering, relentless wave of illicit funds constantly trying to force its way into the legitimate banking system. And to put a microscope on just one nation to see how this plays out locally, public reports estimate the criminal economy in Sweden alone is around 350 billion Swedish krona annually. To put that into perspective, that's about 5.5% of their total GDP. Financial crime has actually become the main criminal market there. It's highly organized, often operating quietly, right in plain sight, using legitimate-looking corporate structures, fake storefronts, or shell companies as vehicles to discreetly move dirty money. We're talking about incredibly sophisticated administrative financial crime. So how exactly does your bank protect the broader financial system and your hard-earned deposits from this massive criminal economy? We enter Section 3, the invisible machinery, transaction monitoring. The primary defense mechanism all comes down to transaction monitoring. Think of this as continuous, mandatory, automated surveillance running across the entire institution. Unlike static background checks that just happen once when you open an account, these systems dynamically evaluate the ongoing daily behavior of every single customer. Every deposit, every wire transfer, every withdrawal, it's all mathematically analyzed in real time to spot suspicious patterns that might point to money laundering, human trafficking, or terrorist financing. But you might be wondering, how does a computer system actually know what suspicious looks like? Well, it does this by connecting directly to KYC, which stands for Know Your Customer. KYC establishes the foundational baseline of what normal behavior looks like for you individually. By verifying your identity, your occupation, and getting a sense of your expected transaction volumes right when you open your account, the bank creates a highly specific risk profile. Transaction monitoring then watches around the clock to see if your account suddenly deviates from your own established normal. So, what happens when this invisible machinery actually spots a major unexplained deviation? It immediately generates an internal alert. If human investigators at the bank review the data and confirm, yeah, this activity looks genuinely illicit, the bank is legally required to file a SAR, a suspicious activity report, with federal regulatory authorities. This document is the formal alarm bell that officially hands the intelligence over to law enforcement so they can pursue the potential crimes. And listen, this machinery isn't just looking for international drug cartels. It's actively hunting very specific technical fraud types that target everyday accounts just like yours. Let's look at a few. First, account takeovers, where fraudsters literally steal your login credentials to hijack your existing funds. Next, authorized push payment scams. This is where psychological manipulation tricks you into willingly sending your own money directly to a criminal. Then, the system is scanning for synthetic identity fraud, where criminals Frankenstein real and fake details together to create phantom customers and open fraudulent credit lines. And finally, structuring, which is often called smurfing. That's where criminals purposefully break massive sums of dirty money into tiny below-the-radar deposits to avoid triggering mandatory reporting limits. Finding the real criminals in all this endless, shifting data is literally like finding a needle in a haystack. Which brings us to Section 4, the AI revolution, solving the false positive problem. So the biggest historical headache in this industry is false positives. This happens when perfectly legitimate transactions, like, say, you withdrawing cash to buy a used car or suddenly wiring a chunk of money to help a family member overseas, are incorrectly flagged as suspicious by the bank's system. False positives create a massive systemic burden. They delay your important transactions, they understandably frustrate customers, and they just completely burn out internal investigation teams who end up spending all day chasing harmless alerts instead of hunting the actual criminals. Now, what's really interesting about this slide is the sheer drop in those false positives when we upgrade our technology. Look closely at the old-school rule-based systems. They operated with a staggering false positive rate of 95 to 98%. That means nearly every single alert an analyst looked at was a dead end. But modern AI-powered systems, they successfully dropped that rate down to between 30 and 50%. And importantly, while rigid rule-based systems can only catch known crimes they were explicitly programmed to find, AI learns dynamically. It continuously detects novel, completely new patterns of criminal behavior as syndicates change up their tactics. But here's a vital, non-negotiable distinction in this industry. AI is not replacing human investigators. The core philosophy in financial security right now is to automate complexity, not judgment. The AI's job is to rapidly score risk, crunch the insane math, and detect incredibly complex behavioral patterns across millions of data points in real time. But once it flags an anomaly, it packages all that context and hands it over to a human analyst, a human in the loop. It's that human investigator who uses their expertise and nuance to make the final, defensible, and legally auditable decision. Let's look at the life cycle of one of these alerts to truly appreciate the machinery at work here. It is breathtakingly fast. A transaction occurs, you tap your card, that takes about 1 millisecond. Within 1 second, the AI has already scored the risk of that tap and pulled together your entire historical financial context. Within an hour, a human analyst is actively reviewing that alert on their screen. And if they determine it's genuinely suspicious, the bank has a strict timeline of 30 days to thoroughly investigate and formally file that suspicious activity report with the government. So, the crucial point is that getting this right is absolutely not optional for financial institutions. If banks fail to maintain adequate modern transaction monitoring, they inadvertently become unwitting facilitators of massive criminal enterprises. And global regulators, they do not take that lightly. In the year 2022 alone, global anti-money laundering fines handed out to banking institutions for having inadequate monitoring reached a staggering $10.4 billion. The financial and reputational stakes are just monumental. And that brings us right back to you and the device sitting in your hand. The next time you effortlessly transfer funds while waiting in line for your morning coffee, think about the incredible invisible journey of that data. From the behavioral biometrics verifying your identity on the glass, down into a massive AI-powered global defense net analyzing millions of behaviors in mere milliseconds to hunt down global syndicates. In the delicate balance between seamless convenience and rigorous, necessary security, take a moment to appreciate the invisible shields quietly protecting your money every single day. Thanks for joining me on this explainer, and keep questioning the complex systems that shape our modern world.